Hey, it's Patrick from Advisor Growth Experts, where we teach financial advisors how to buy, grow, and eventually sell their RIA for more. I am back with the next episode in the Build in Public series, which is a series that's designed to help you as the financial advisor get a sense of how I'm thinking about building my RIA from about $3 billion in assets upwards of $20 billion over the next couple years, some of the decisions and things that I'm making as it relates to marketing, operations, scale, growth, all the fun stuff that we have to deal with as financial advisors. So over the past week, I've been pretty busy. I was actually traveling to Colorado Springs for the Future Proof Retreat. So I got to meet with a ton of financial advisors, other industry players, had a lot of great conversations. It was a very valuable event. So if you get a chance to attend next year, I would recommend that you do that. And one of the sessions actually really caught my attention because there were a lot of financial advisors who are interested in the topic of M&A. So it was a breakout session over lunch that was facilitated, and a lot of the questions that were thrown out were around the idea of how do you value a firm? Like, how do you make sure you're getting a good deal? How do you calculate your returns? How do you negotiate with the seller? All the questions that maybe if you've done a transaction or you're thinking about doing a transaction, you may have thought at one point in time. So I figured I would just hop around some spreadsheets and answer probably two of the most pressing questions that came up during that lunch. The first one was about multiples and this idea of using revenue multiples, not using revenue multiples, or how to think about, a multiple of EBITDA. What does that actually mean? So we're going to unpack that. And then also, more importantly, how do you calculate the return that you get as an acquirer from buying someone else's practice? Because we've seen these multiples in the media, 10, 11, 12, 13x. So I want to walk you through a spreadsheet and bring us all back to reality on what a reasonable expectation is around internal rate of return and maybe what a future exit price could look like if you were to resell your firm along with the acquisition later on down the road. All right, let's talk through revenue multiples, and then we're going to get into calculating the return on an acquisition. So we've got practice A and practice B. I just want to hammer this home because the industry focuses a lot on revenue multiples, and I think they're completely irrelevant. So this won't take long, but just want to make sure we're on the same page as it relates to valuation. Practice A, practice B. Both have $1 million in revenue. One has operating expenses of $600,000. The other has operating expenses of $250,000. Owner's compensation or advisor compensation is $200,000. This could be for the advisor continuing on after the acquisition and working for the company, or just hiring a replacement. EBITDA in practice A, which is just your profits, are $200,000, and in practice B they are $500,000. So if you just got a valuation solely based on revenue, and let's say it was a 3x revenue multiple, both of these practices are worth the same amount. But in reality, practice B is a lot more efficient at generating cash than practice A. So if we look at EBITDA, which is a much better valuation metric, practice A is only worth 1.1 million, whereas practice B is worth $3 million. So which practice would you want to buy? If it was me, I would definitely want to buy practice B. You could argue that there's maybe some fluff and other expenses in practice A that you could slash and you could generate your cash flow after the acquisition. But then the question is, why would you want to pay the same amount of money for a company where you have to do more work and then your profits are more uncertain? And a lot of times what you'll find is when you do these deals, the advisor who you're acquiring has a lot of leverage in the deal because they have the client relationships. And if their brother-in-law works for the company, they may say up front, we'd be willing to let go of Tom and add that back to the, to the valuation. But once the deal's done, are they really going to do it? And from my experience, it's a lot harder once the check is cleared and everybody is, the champagne is run dry, so to speak. So always value a business based on the EBITDA multiple, never on the revenue multiple. Okay, let's hop over into the more complicated spreadsheet, and we're going to go through XYZ Wealth, an acquisition of this company called XYZ Wealth. I am going to walk you through a workbook that we created here. I'm going to start here. So I'm going to try not to confuse you too much with this worksheet, but acquisitions are confusing. You may need to be confused a little bit in order to get there. So I'm going to do my best in order to outline this transaction in a way where you can understand and you can get what you need to know about the performance metrics associated with M&A. So we've got this same $1 million practice, $1 million in revenue. We're going to assume that all of this revenue is recurring. We're going to assume a 10% growth rate on revenue year over year, which I'll show you in a subsequent tab. We've got operating expenses of $250,000. That's like your technology, your office, your leases, things of that nature. We're going to assume that expenses grow at 5% a year. Then we've got advisor partner salary of $200,000 and partner e-box split, which is essentially just operating profit at 20%, which means that after the transaction, 20% of the growth in operating profits is going to be paid to the advisor who's running that office. It could be the advisor that is currently there or their replacement. And we can move this all the way up to 50 or so percent. That's generally the highest I'll go. And I'll kind of walk you through how that affects the deal. So recurring EBITDA, again, 1 million minus 250 minus 200 is $550,000. We're going to apply a EBITDA purchase multiple of 5.75. This is just arbitrary for the purposes of our example here. And this gets our practice purchase price to $3.162 million. We're going to assume there's no cash in the deal for right now and that all of it is financed. 20% is going to be a seller note. This means that the seller is going to carry 20% of the transaction and we're going to, as the buyer, make interest and principal payments to the seller on a predetermined schedule. And that note is $632,000, which is just 20% of the 3.12 million, or 16 million rather. And then we've got a bank loan of 80% that will be issued by a lender. And if you're not familiar with lenders, you can look at Live Oak Bank, Oak Street Bank. Just put in the comments if you need a referral. I'll help you there. But we're going to assume that 100% of the 80% is financed through one bank. Okay. So if we come up here to the loan criteria, we've got 2.53 million that's going to be financed by a bank. The interest rate 7.5%. It might be higher depending on how the bank is underwriting the risk. And then we've got monthly payments, a 10-year amortization schedule, and it's just going to run out over 10 years that way. Down here, we've got our second debt, the seller note, and that's going to be $632,500, a 7% interest rate, monthly amortization schedule, 10-year term, and there's going to be a balloon payment, which means that we're going to pay it off in 5 years and a 1-year grace period, which means we're just going to make interest payments for the first year, which is not uncommon to make sure that the what are called debt service coverage ratios work for the bank. And then lastly, this is kind of getting into the weeds, but the purchase price allocation. So when you do transactions, especially if you structure them as an asset purchase, you have the ability to write off the amortization of goodwill and other assets that you're purchasing. Goodwill is generally amortized over 15 years versus more fixed assets are going to be 5. So we're assuming a 95-5 split on amortization, just to keep it simple. I'm not going to spend any time here. These are just the amortization schedules for the debt, but I want to jump over to the dashboard. So let's look at the dashboard. We're going to unpack some of these return metrics. I'm going to start up here. We've got our acquisition price of $3.162 million, our recurring EBITDA multiple of 5.75. We're going to assume 0 cash or equity is in the deal. This is all debt. This is all going to be debt. And if we go to investment profitability, we're not looking too good. We've got a 2% internal rate of return. So the internal rate of return is the discount rate used to bring future cash flows back to a net present value of 0. It's basically just our annual return that we would expect from this investment, which is not great. And the discount rate that we're using is 8.7%. This is called the weighted average cost of capital. It's calculated here. It's essentially just a risk-free rate plus some equity and debt risk premiums. We use kind of a weighted average in order to arrive at the weighted average cost of capital. Now, I'm not going to give you the corporate finance lesson. You can assume that this is fairly accurate. We're going to look at the internal rate of return in greater detail here in a minute. But first, we've got a payback period of 9.5 years, which means that if we acquired this business and the revenues grew by 10%, expenses grew by 5%, and we accrued the cash, it's going to take us 9.5 years to recoup our investment. And the enterprise value, I can show you that calculation. And then down here, we've got a resale of the cash flow or the EBITDA in the business at some point in the future. So I'm going to get to that. But basically, you can see that this 2% IRR is not that attractive from an investment standpoint. And if you look at what's going on in the industry right now and you see in the trades like, oh, this company sold for 12x, 13x, 17x, it's like, well, once we get to 7, we're pretty much negative on IRR without a resale. if we're not putting considerable amount of cash or equity into the deal. So the lower your multiple, the better the investment profitability is going to be. So years ago, when we were closer to that, like 3, 4, 5x, you could generate a pretty solid rate of return by doing these types of acquisitions. But now it's really getting sucked out of the market, and it's interest rates aren't helping them, that's for sure. But it is it's going to be out of reach for a lot of advisors unless you're willing to think about reselling your company along with the company you're acquiring down into the future. So let's kind of step through the income statement and the statement of cash flows, and then I'll jump back here to the dashboard. So we've got our $1 million in revenue. We've got our growth rate of 10%. You can just see that the revenue is growing at 10% a year. We've got our operating expenses that are growing at 5% year over year. Our EBOC, earnings before owner's compensation, which is essentially just operating profit, is just revenue minus expenses. And then we've got our advisor's salary and their split on the growth in operating profits, which is increasing every year. And then this gives us EBITDA, which is essentially the cash flow that's available for debt service and everything else that we're going to need to run the operations of the business that we're acquiring. It will, in addition to their current operating expenses, be more for our corporate operating expenses. So we've got our EBITDA margin, and we've got our amortization of goodwill. You can see that. Purchase price over 15 years subtracted from our EBITDA. And this is really just to arrive at our net income after tax so that we can figure out what our taxes are going to be, because we can't use the money that we're giving to Uncle Sam for debt service. That's not going to be incorporated into our investment profitability. It's just going out the door. So we have to be mindful of that when we're doing these types of transactions. So now that we have our cash flow, our income after tax, we can start looking at our statement of cash flows to figure out how much net cash flow what are we using in order to calculate these, the investment profitability. So again, 2024, we've got our metrics down here. Our EBITDA is 550. Everything's growing at 10 or 5%, depending on if it's revenue or expense. And then we are calculating net cash flow, which is essentially we're just adding back amortization because that's not a cash expense. This is getting into more corporate accounting. But we're adding that back in. We're subtracting taxes because that's going to Uncle Sam. And then we are getting rid of our debt and principal payment because that's going to the bank. So net cash flow is, not significant. Let's come down here to the internal rate of return of 2%. So the calculation for internal rate of return, you can see we're basically modeling these cash flows out over 10 years. They're growing because revenue is growing more than expenses. But we still have this large chunk, right? This $2.9 million that we had to pay for this business. And it's really pulling down our rate of return, considering, we've got a pretty strong carry of interest and principal against, the EBITDA that we bought. So since this multiple is reasonably high, it's really hard to actually generate any profit. And it's also hard for us to hit what are called our debt service coverage ratios. So the debt service coverage, I'm going to jump back over here to the dashboard, is what the bank needs to see in order to finance the deal, to feel comfortable about the cushion between the amount of money that you owe as the borrower, your interest and your principal payments, versus the amount of cash flow that you're generating from the deal. And generally, that ratio of interest and principal divided by the cash flow in the deal needs to be 1.2 or higher. And most banks are actually looking for more like 1.4 to 1.6. So this deal isn't bad. It's close to kind of where we'd want to be, but it's definitely getting to the higher end of the range as far as what banks will be comfortable with when they underwrite these types of deals. So any more than this, you can see we're dipping down into getting closer to that 1.3, 1.23, and the likelihood of the bank, financing this deal is going to be lower and lower. So really what everyone's betting on here, because they're not making a lot of money when they're bringing the advisor over and they're cash flowing this business. They're not making a ton, but where they make money is if they could repackage these cash flows and sell them for more. So let's assume in 2027 that this business was acquired. This business that you purchased for 5.75, you acquired a couple more, and then you sold all of it for 10x. And we're just going to analyze this particular business's EBITDA in the sale. But let's say in 2027, you resold this business that you purchased. At this time, it had $783,000 in EBITDA. 10x multiple on that, we get 7.82 enterprise value. We subtract out the debt that we still owe of 1.67 million. And now we have equity value of 6,161,000. This gives us a nominal return of 195%, which is a great return. And we could factor this into the IRR calculation if we wanted to, and make that a cash flow in whatever year the business was sold. That would obviously pull the IRR up dramatically. But we really want to look at these separately, because this is not a guarantee of reselling the business. And some advisors, when they do these types of transactions, their goal is not to sell. Their goal is to actually turn a profit. So really, you want to look at these two separately to figure out what is your actual profitability on this investment if you were just going to hold it. And I think, I've made a fairly compelling case that it's not that great in the event that you're paying upwards of like 6x, 7x or more for these businesses. So I hope that was helpful in modeling this out. M&A can be fairly complicated. So ideally, I wanted to break that down as clearly as I could so you could see kind of what multiples are reasonable and how these things impact the deal. If we move this up to 7, this pulls our IRR down to negative 4.4. which is just not going to be an acceptable range. We pull this to 4 and now we're at 15.1%. So you really want to make sure that you're not going negative in these types of situations. You want to model out the tax impact. You want to make sure that you're structuring the deal correctly. Generally, you're going to want to do an asset purchase so you can amortize goodwill and other assets correctly to offset taxes, to free up more cash flow for debt service. But yeah, if you have any questions, feel free to put them in the comments. I'm happy to answer them. I also offer a program called the M&A Co-Pilot, which is designed to help financial advisors learn everything they need to know about these types of situations and how to do deals and how to come out on the right side of it. So I hope that you found this information useful, and I will see you in the next video.